Ladies and gentlemen, Tom Lee, one of the best predictor of the US stock market, has came out with a prediction that is very precise on the path that the S&P 500 will move. So he has predicted that the S&P 500 will hit 73,000 points and then it will crash, and then follow after that will be an astronomical rise. Let's watch and see why did he make such a prediction, and more importantly, validate it against history and see whether that indeed has happened and probably will happen or not. So this journey of the stock market that Tom Lee predicts is one that is very precise in his estimates. And I think this journey is worth looking at, because if it's coming true, then I think that warrants us to prepare ourselves with some strategies. So where do we stand today? The S&P 500 has closed at a record high of 7,200 points, and congratulations to all who held on to your positions and probably even added some new positions over the crash that has just happened a few weeks ago. So the market is right now hit all-time high, and he has predicted that it will hit 7,300 points, and that prediction was made even way earlier. So he's just 1.3% away, his prediction, from where we are right now. So maybe it could be within days or even a week or so that we hit 7,300 points. But what is more important is his next prediction, which is that the stock market soon will test the new Fed chair, and it could test it significantly, bringing the stock market down by a massive crash, and following after that, there will be a massive and astronomical uplift. So why did he say that? Wow, is something that is quite interesting. So meanwhile, the Federal Reserve new chairman has cleared some clearance already. It's not fully cleared, not appointed yet, but it's clearing. So Kevin Warsh is nearing his new appointment. Jerome Powell, more or less, is going to hand over to him. And all these are happening in a macroeconomic and geopolitical backdrop of a serious Middle East war, which oil prices have spiked up at least to 135 points for the Brent crude before it corrected a little bit. And the inflation is rising right now and is the highest in 3 years. So against this backdrop, we have a new Fed chair, and this is quite textbook case of a testing of a new Fed chair. Tom Lee's hypothesis is that the Federal Reserve new appointment of the Fed chair will cause the stock market to test him. Well, from the 7,300 points that Tom Lee has predicted, there will be a testing. And the testing period is likely to be between June to October. He's likely to be appointed somewhere around June to July based on history, because there are some clearance to go through and some Senate to approve. And after that, most likely there will be a testing. And to be frank, that testing might coincide with something that happened in Middle East. Right now, Donald Trump is being briefed by his military leaders that maybe it's time to take a military operation because they can't wait forever. So I don't think people are doubting that the stock market will hit 7,300 points. That's already within a hair's breadth away. But the crash is something we're not too sure will happen. And later I'll show you what history tells us. And more importantly, after that, he predicts that somewhere around end of the year, November, December, there'll be a massive rally. And that could coincide with the resolution of the Middle East crisis. So his year-end target remains at 7,700 points, and that's a massive number from where we are today. I think it's important to understand what do we mean by testing of the new Federal Reserve chairman. Well, every Federal Reserve chairman has a function, and the market expects him to perform a certain role independent of political pressure. So number one is, does the market believes that Kevin Warsh, if he's appointed, will he be able to perform independently of what Donald Trump wants him to do? And that one is highly under question right now, because he's appointed specifically by Donald Trump in expectation that he will follow what he wants to do, which is basically to cut interest rate. So whether he will do that in the right time is the question. Second of all, when there is a crisis, can the market trust Kevin Warsh to push the Federal Reserve to do the right thing to protect the economy? So all these are testing of the new Fed chair. And what we don't want to see is Kevin Warsh is a kind of a puppet for the White House, in particular for Donald Trump. So this is where the testing will likely to happen. Now, just to be very clear, there is a history of such testing happening. So 10 out of 13 Federal Reserve chairmen face a drawdown of 10% or more in their first year. So the hit rate is almost 80%. And within 6 months of a Federal Reserve chairman taking office since 1930, the average drawdown is about 16%. Some more, some less, and I'll show you later. Now, if 16% were to happen, it means that the S&P 500 from a 7,300 points could draw down as much as 6,100 points. Now, if what Tom Lee says is correct, that it could even touch 20%, then we are looking at 5,800 points. Now, these are severe drawdown. Now, I don't know whether this will happen, but this is what Tom Lee says. Just to look at history of some examples. So in 1930, Mayer, which is the Federal Reserve chairman, was appointed, and the market drew down by 44%. This is the maximum drawdown. Arthur Burns, 25%. Greenspan, 35%. Paul Volcker, 18%. Bernanke, 15%. Jerome Powell, 12%. You can see that within a 1 year period, this drawdown actually happened, and there are different reasons why this happened. So you cannot predict the cause, but you can predict the frequency. Sorry, you can look at the frequency and predict that the likelihood of this happening is very high. And we do have one political and economic pressure right now, which is the oil prices is spiking up because of the Middle East crisis. So this is something that we're all waiting and see whether this thing will cause the oil market to spike up and then cause the inflation to go up and then cause the stock market to fall. So it is not unthinkable there'll be a testing of the Fed chair in that sense. Now, why is the Fed chair test highly likely is what I said. There is a geopolitical event. And interestingly, the previous Federal Reserve chairman, which is Jerome Powell, he's still staying as a governor in the Federal Reserve. So there's be kind of a tension because Jerome Powell is famous of having a backbone on his own and stand up against Donald Trump. So if that is the case, then we don't know whether what the dynamics will be and how it will affect the testing of the new Fed chair. Now, it's probably time-worthy to talk about the V-shaped recovery after the testing of the chair. So 9 out of 13 times, the recovery after the testing of the Fed chair has been V-shaped. That means it's a phenomenal rise, okay? So within 6 months, if you can see, these were the percentages that it rose within 6 months. And these percentages, when you look at it like 10, 20, all this looks small, but it's within 6 months. And after 12 months, look at this, 1934, almost 50%. And then you have got a couple of 10% or so. So now take note, there is one case which is Ben Bernanke, which is 0.9%, but after 1 year, it actually hits 12% as well. So that's how Tom Lee predicts that there could be a powerful recovery after the testing of the Fed chair and after the market dip. Now, just to look at the actual mathematics, if what he says is correct, 7,300 points is going to be the peak before the drawdown. 16 points would means 6,100. If it's a 20-point estimate, there'll be 5,800 points. And if from these points we have a recovery, then we are talking about a recovery to 7,700 points, which is what Tom Lee predicts the market will go. It will require a 25 to 30 or even 40% rally. That's even more than what was previously predicted. Okay, so we are looking possibly at a massive rally if what Tom Lee says is correct at the end of the year. Now, there are a couple of scenarios that can happen between June to December 2026. Take note, we don't know whether what Tom Lee says will come true. Yes, he has been pretty accurate, but he's not God. We don't know whether what he says will actually come true. So between now to December, these are the likely things that could happen. In a base case, maybe from a 7,300 points, which is only 1.6% away, it could go down by about 16%, which is the average of what has happened previously, then recover to 7,007. If this is going to happen, then this is the base case. Now, there could be a bull case, meaning that the fall is actually very weak. So from 7,300 points, it wobbles down to minus 8% only, and then it drifts up to 7,007. The bull case is very likely, and if that were to happen, it's most likely there's an Iran ceasefire and everybody celebrates. The market never really crashed and so on, happily ever after. In that case, 8% with drawback may not warrant us to fire too much. In this exceptional case, we have to decide whether do we want to deviate from a crash buying practice I always practice. Now, then, if there is a big crash, for example, the oil prices spike to $130, which is actually just $5 away from what we almost had on Friday, and there's a stagflation, and then the Federal Reserve chairman, his credibility is being tested and failed, then we're looking at a massive crash of maybe 25% or more, okay? In that case, the stock market will be quite seriously affected. Then there could be a delay of recovery. Then the 7,700 points by end of the year may not happen. So nobody knows what could happen. But what we are, I would say, intrigued by is the history that this is happening, and this could happen easily because of the current situation. So what do? Well, I always tell everybody, form a strong financial safety net with your CPF first, whether it's your SA or OA, let it compound. Now, for those people from Malaysia, use your EPF as a strong financial safety net. Let them form there and don't touch those. Only above that, then you touch some of the funds. So do not use funds that you need in that sense to touch the stock market if you cannot afford to lose. And this is where I think it's very important to form a strong financial safety net. So the thesis of what Tom Lee is saying, that the market will first crash, then rebound, could not come true if there could be a sudden ceasefire and the oil price collapse. And I can assure you in the next few period, there will be a hell of oil because of all the strong supply they have been building up in their reserve. So they will throw a lot of oil in the market and oil prices will crash. I think that is a possibility. But that will require Iran to give in to what Donald Trump is pressurizing. Will that happen? I think the chances is low, but not no. And we also could have a situation where the AI boom even more, that it invalidates all the pressure that we have on Middle East oil crisis. So it's really hard to say. So what I'll do is that, I'll watch the market pretty closely, and if what Tom Lee says is correct, I will go in. But if it doesn't happen by what he says, I'll just let whatever I have continue to compound. So in short, I go back to my usual stance. We don't need to predict, we just need to react. So we will know this situation outcome very, very soon. Okay, it's not something I have to wait for a few years to test. This is coming in a matter of days, okay, or weeks. So we'll see whether this V-shaped pattern will come, and then we can deploy according to what we are used to. So let's see whether this thing will give us some opportunity. For those people who don't believe in this, that's fine. Do whatever you want. For those people who believe in this, just need to get ready. All right. Thank you. And let me know your opinion of this. We shall see this very soon. Okay. I'll see you in the live stream. Thank you and goodbye.